So welcome aboard, folks. 2 hours today. 2 hours. Why am I screaming? I'm excited. We got 2 hours. Mixture of multiple choice and task-based simulation. So we'll be rocking that. UWorld, who are we? You got to Google it because we are the best of the best. Accounting is now going to be the #1 product for this entity. We are excited because we have merged the best talent from Roger CPA Review, which is not only Roger himself, who's unbelievable, but his entire team, including Rob Bass, putting all the content together. Then we've got the UWorld team, unbelievable. Then we've got the Wiley folks. You got to check it out. The Wiley folks who joined us because they acquired Wiley. And then I joined from some organization that I can't remember the name. I was there for like 25 years. I can't remember. That doesn't matter anymore. So yes, we are very excited. What an unbelievable team. All kidding aside, tremendous experience, not only in teaching CPA review, but just as importantly, if not more importantly, industry expertise. So you're going to be taught by audit by people who actually did audit. You're going to be taught tax by people who actually have done tax returns. Yes, you would think that that's a prerequisite, but I can tell you that's not. Unbelievable. So yeah, what a team. Very excited to be a part of it. So why are we doing this, folks? We are hoping, look, this business is built on word of mouth. It's like, taking a car for a test drive, trying that shirt on. You're trying the UWorld shirt on today. That's right. You're trying on your UWorld shirt. But all kidding aside, I think it's only fair, your firms who've gotten, to get to choose should give you all the choice, because at the end of the day, it's the product that's going to work best for you. And one size, as we all know, one size doesn't fit all. So you got to find the review course, quite honestly, that's going to work best for you. And if you've become accustomed to a particular instructor, I think it's only fair. They let you have the choice to continue to study with the one and only Roger and the sweet sugar bear. Let's go. All right. So these are the questions we did last time. Do you remember these? We're just taking a little trip down memory road. This is where we left off on the multiple choice. So this is where I am starting today. By the way, any of my UWorld friends on the line, Mad, you want to say hello, Mad? Don't be mad. Or Rob, say hello. Let them know it's a big team.
Hi, everyone. We're here answering the questions in the background, so we'll all be answering your questions, and we'll save a few of them live for the end for Pete.
Sweet. And Rob, say hello, Rob Bass.
So this is Rob. I'll say hi. Welcome, everybody. We're very excited to have you with us today. I do have a great team who has put together all the materials for 2024. We're excited to have you, and we're excited to be with Pete today. Thank you, Pete.
Awesome stuff. Awesome stuff. I got Rebecca and John on the line as well answering your questions. So thank you all for joining us today. But yeah, we got some serious business to do. So let's start banging it out. And here we go. All righty. Exam day, you are not going to start up here because you have no idea what to do with all those facts, right? So where are you going to start exam day? Question STEM. They want to know what's the total value of material costs is what we're looking for, not conversion. We're doing ending work in process, and we're using FIFO, cost inventory valuation method. Stop right there. If we're doing FIFO, what's the first thing you think? 3 steps to get that equivalent unit. So the first thing I want to do, set it up. I need my FIFO equivalent units, and I remember 3 steps. So before I even read the facts, I'm setting it up. I need my beginning inventory times 1 minus the percentage given. How much work do I have to do this period to finish what was started in a prior period? Then I need what's called started and completed. The units completed this period minus what's in beginning inventory. And then lastly, I need my ending inventory times the percentage of work that was done this period. So that's step number 1 before you even look at the numbers. Step 2, now I need my cost per unit. Folks, with step 2, with FIFO, what's in your numerator? Current costs only. So current costs only. And then you will divide that by your equivalent units from step 1, and there is your cost per equivalent unit. Then the goal, answer the question asked, my ending work in process. So I'm going to take my ending inventory times my percent complete. That's my equivalent units for ending inventory, times that cost per equivalent unit per step 2. And there is my answer right there. So notice I haven't even read the facts yet. I got it all set up, because if you read the facts and you don't know what to do with it, you'll be wasting valuable exam time, right? So now let's see what was in beginning inventory. So they tell me beginning work in process was already 30% complete. So what did we have in beginning inventory? I had 150,000 units. How much work did I have to do this period to finish it? 150,000 units times 1 minus that 30%. 70% of the work this period, 105,000. How many units were completed this period? 600. How many were in beginning inventory? We just saw 150. So 600 minus 150, 450,000 started and completed this period. How many units are in ending inventory? April 30th, 300,000. What percent were those done? Well, 300,000 times the percent complete, 40%. So that's 120,000. Add it all up. Step one is complete. There are my equivalent units. So 675,000 with respect to the materials. That goes into my denominator, step two. Now I'm looking for my current cost only. Under FIFO, what's the cost in beginning inventory? Under FIFO, folks, that is distractor information. We would use that if we're doing weighted average. So I'm going to take the 1,755,000 current costs only, divided by my equivalent units from step one. I got a cost per equivalent unit of $2.60. That goes now to step three. What was in ending inventory again? 300,000 units. Those 300,000 units are 40% complete. So that is the equivalent of having 120,000 finished units. 120 times 260, 312,000. Now, if you're religious, you will say a prayer. Hopefully that's a choice, and there it be. Let's go. One down, 450 million questions to go. Now, part of what we do with the course is not just show you, obviously, answering this question. That's incidental in the process. What if this were weighted average method instead? So now I'm going to change the facts, and I'm going to say, no. What if it's weighted average? You ready? So now let's review weighted average method. Step number one, if we had to do equivalent units, weighted average method, 2 steps involved to get those equivalent units. Number one, I need the units completed. And then number two, I need the ending inventory times the percent complete. That will get me my equivalent units weighted average. Step two, cost per unit. I need my beginning costs and my ending costs. Notice the difference. FIFO was current costs only. Okay, so let's use the word current. Beginning plus my current costs. I need both of those. Divided by my equivalent units per step one. Then I will take what's in my ending inventory times that percent complete. There's my equivalent units for that ending inventory. Multiply that by my cost per equivalent unit per step two. And therein lies the cost that we're going to allocate to our ending inventory. All right, so here we go. How many units were completed? 600,000. How many units are in ending inventory? 300,000. 300,000. Drop the zeros, by the way. Little helpful hint. Drop the zeros so you can move more quickly. 300 times the 40%, 120. Equivalent units, 720. You now put that in your denominator. Beginning costs, 108. Current costs, 1,755,000. We need both of those in the numerator. So notice the difference, weighted average method. We have both current costs as well as beginning costs. So the 108 plus the 1,755 divided by the 720, I got 2.5875. 2.58 would be just fine, but I like to be very precise. But you all could do the 2.59. You can round up. That'll be just fine for exam day. So 2.59 cost per unit per step two. Ending inventory, 300,000 units times 40% complete. That's 120,000 equivalent units times the 2.59, 310,500, approximately 311,000, depending upon the rounding. So obviously that's not an answer choice because they didn't ask for weighted average method. They asked for FIFO method. Now they were kind, I guess they were kind there, all righty. But that is your weighted average method. Okay, I love this visual, folks. Look at the equivalent units. If you have 8 cups of coffee, let's make it coffee, that are 50% full, that's equivalent to having what? 4 cups of coffee, 100% full. Now, speaking of cups of coffee, come on, man. You want to pass BEC? Let's go. Put the time and effort in. If you are a UWorld student or a student of that other course I used to teach for years and years ago, listen, man, keep me posted. If we're not connected on LinkedIn, I'd love to hear from you because when you pass, you know I owe you a cup of coffee. So let's go. All right. Theory questions. What's the difference between job order versus something called process costing? Remember process costing? We mass produce homogeneous units. Every unit is the same as every other unit. Cans of paint. With process costing, we got to take partially completed units like we just did, convert them to equivalent units because I need to have a value on my balance sheet for that ending inventory that's in work in process, okay? So any units that are part of finished goods, well, if they're finished, they got to be 100% complete. If they're still in work in process, obviously, they're not 100% complete. Now, when you're studying, folks, you should compare and contrast process costing versus job order. What do we remember about job order costing? You're going to use that when you have relatively few units, right? Instead of mass producing homogeneous units. They're easily identifiable. Think about a boat, a car. They each have a VIN number. They're relatively unique, okay? Relatively unique. All right, if they're going to have a higher cost per unit for that boat, that car, whatever it is, all right? So that's job order costing. Okay, folks, one question down, 6,000 to go. Here we go. They want to know, start here. What is the standard direct labor cost on a per unit basis? So I'm looking for direct labor cost on a per unit basis. So I'm thinking standard direct labor cost per unit. So I need to know my cost per hour for labor. What is my cost per hour for labor? And then I want to multiply that by the standard hours allowed, the standard hours per unit. How many hours does it take to make each and every unit? So let's see what they've given us. Set up my formula first. Now I'm going to cherry pick the relevant information. What is my standard cost? My standard hours per unit. We have one piece of the puzzle. It takes 2 hours per unit. The number of direct workers is 50. The number of productive hours per week per worker, 40. And then they gave me the wages per worker. So I don't need the 50, the number of direct workers. Okay, I just need what are my wages per worker. So folks, if per worker, $500, and they work 40 hours a week, what does that cost per hour? $12.50 is the labor cost per hour. I'm thinking that's going to be part of my solution, but then they tell me I got workers' benefits. Oh yeah, that's part of my direct labor cost. Now that's 20% of wages. What are our wages? $500. 20% times 500, that's $100. On a per hour basis, that's 40 hours per week. I need everything on an hourly basis because each unit takes a certain number of hours to make. Okay, not weeks, not days. If it were weeks or days, we would adjust accordingly, but it's on an hourly basis. So the $100 divided by the 40 hours per week, $2.50 per hour for the benefits. Add it together, we got $15 labor cost per hour, $15 labor cost per hour. So the standard is a per unit basis, not per the number of workers. So that's distractor information. takes 2 hours to make each and every unit. I need my labor cost on a per hour basis. So the labor cost per hour, $15 an hour, 15 times 2, $30 is your standard direct labor cost per unit. You know what the most common mistake is? Someone chooses $15. No, that's the hourly rate. That's not what they asked for. That's why it's so important. Step one, you set up your formula. We wanted the standard direct labor cost on a per unit basis, not the $15 per hour. While that was part of our solution, that's not what they asked for. Now, they could have asked for that, but that's not what they asked for. Okay, now, when it comes to direct labor, you ready? Direct labor, sometimes we're going to take our actual hours times our actual rate that we pay per hour. And what does that get us? Our actual labor cost. Actual cost for labor. I want to compare that to the actual hours, but times the standard rate per hour. What should we have paid per hour? Okay, what should we have paid per hour? That gets me the standard cost for labor. Now, what am I hoping? I'm hoping that the actual cost for labor is less than the standard cost for labor, right? That would be favorable. That's what we're hoping for. Now, that's called your rate or price variance, your rate or your price variance. All righty, now that's based upon the actual rate versus the standard rate. Now that would seem like that's good news, but remember something, folks, sometimes you get what you pay for. So you can't just look at the rate or the price variance, the weight, you gotta look at the productivity as well. So then we want something called standard hours allowed. Okay, I want to compare that to the actual hours worked. I'm hoping the actual hours we worked are less than what I budgeted for. I'm hoping they were very productive, very efficient. That gets multiplied by your standard rate. Okay, that gets multiplied by your standard rate. All righty. So this is an efficiency variance, an efficiency variance. Then you can net these two out. Then you can net those two out. Okay, but therein lies your efficiency variance. Okay, so standard hours allowed. How do you get standard hours allowed? Standard hours allowed is your standard hours per unit, which in this case is 2 times the actual number of units produced, which we do not have here. So I can't tell you standard hours allowed. Okay, we do know, the only thing we know is our standard rate is $15 an hour based upon this budget. All right, but we don't know the actual rate or any of that other stuff, okay? So this is your labor variance. Labor variance. Know it inside and out. You want to know why? Because this is 2 for 1. Later on, when we do variable overhead variance, you set it up the exact same way. Exact same way. We'll see that later. Okay, so that's 2 for 1. This setup is 2 for 1, and I'll show you how it's going to be used when we do the variable overhead variance. So once you've mastered your labor variances, you're going to be in great shape. All righty. So let's take a look now. Oh, by the way, I want to remind you, your product costs, folks, also known as what? Inventoriable. Also known on the exam as manufacturing cost. Do not get expensed, obviously, until the product is sold. Do not get expensed until product sold. So your product costs, also known as inventoriable or manufacturing costs, that is a function of your direct materials plus your direct labor plus your manufacturing overhead applied during the period. Applied. What does applied mean in English? It's estimated. Oftentimes, because your manufacturing overhead is made up of indirect costs, many times we don't know what that actual cost is until the end of the period. But we can't wait to the end of the period to assign costs to our products. So we have to estimate it during the period by applying that overhead, okay? And I'll show you how to apply overhead in just a little bit. But that applied overhead, adding to the direct materials and the direct labor, okay? Notice direct materials, direct labor, those costs put together are called prime costs. So sometimes they're given separately, sometimes they're given together, okay? Your direct materials, direct labor. Add that together with your manufacturing overhead applied, there's your total manufacturing costs, okay? Your total manufacturing costs. And I'll show you other formulas in just a little bit. Folks, when we do variance analysis, why do we do variance analysis? To control costs and try to improve performance. Again, paying somebody a cheaper rate does not necessarily overall benefit the company if they're far less efficient. So we got to look at the rate variance along with the efficiency variance to determine what the best combination is. Sometimes you'll pay more per hour, but they'll be a lot more efficient. Now, the standard, the budgeted, the predetermined target, many times that's an industry standard. But the goal is, the magic word is it should be attainable, because that motivates. If it's ideal under perfect conditions, you know from working in the accounting profession, if you've done an audit, you know, it's one of the things I remember as being an auditor, the budget was very aggressive, because I remember they were like, hey, Pete, you're gonna, do these tests, whatever it was, and this should take 2 hours. 2 days later, I'm like, damn, how did anybody ever do this in 2 hours? And then I realized nobody ever does that in 2 hours. That's insane. So the goal should be for it to motivate. All righty. So it should be under efficient conditions, not perfect or ideal. All righty. At the end of the period, folks, standard costs are compared with what the actual, so that we could determine our variances. Okay. And then we want to determine, are they unfavorable or are they favorable? All right, we'll make it logical, but we'll do more of that in just a little bit. Okay, so in our example, here's our detailed explanatory answer again. Ready? They did not ask for the $15 per hour, okay? They asked for the standard cost per unit, 30. All righty, back to process costing. When you see process costing, before you read, you're thinking mass production of what? Homogeneous units. I have mass production of homogeneous units. All righty. So I'm going to be using maybe FIFO, weighted average, whatever it may be, as we saw earlier. But this is asking, hey, what's the deal with application of factory overhead? What's that application of factory overhead? So folks, we got raw materials. We eventually add the direct labor and the manufacturing overhead that we apply during the period, that we estimate during the period. We take that raw material plus the direct labor and the overhead that we apply, in English that we estimate, those conversion costs. Now we have units work in process. Eventually they'll be finished and they'll become finished goods. Folks, these are all assets on the balance sheet that do not get expensed until the product is sold. Why? This is what we do with our product costs, and we apply the matching principle. Those costs sit on the balance sheet and are not expensed until the product is sold. Then we will match our selling price with our cost per unit, or in total dollars, to measure our performance in terms of gross profit. Okay, now, you ready? What is the flow from start to finish? Your raw materials, your direct materials. You've got your beginning direct materials, right? Plus everything you purchase during the period, your purchases. Those are your materials, AFU, available for use, AFU, available for use. I like that. Minus the ending direct materials, what we did not use. What does that tell us? The materials used during this period. Step one is complete. Okay, now from the last period, I had my beginning work in process. That could be 0 if you had nothing from a prior period left over. Otherwise, you've got units you started last period that will finish this period. beginning work in process. You then add your direct materials used, plus your direct labor. Remember, the sum of those two is called what? Prime costs, plus manufacturing overhead applied. Folks, these three items are known as what? Your current manufacturing costs. If there's any beginning work in process added, there are your total manufacturing costs. Subtract what you didn't finish, the ending work in process, and what does that tell you? Cost of goods manufactured, what we finished this period. Okay, the cost of goods manufactured, the finished goods. In this question, folks, applied factory overhead is part of what? Calculating, figuring out work in process. Okay, it's part of work in process, that applied factory overhead. All right, work in process. The actual factory overhead will eventually be compared to what we applied. So we're going to have a manufacturing overhead account. At the end of the period, I will know the actual amount. In the interim, I've estimated, I've applied it, and then I will figure out whether I'm under applied. If you have a debit balance, under applied, in English, underestimated. Whenever you have a debit balance, the actual is greater than the estimate. That is bad news. Bad news. Conversely, if we're over applied, in English, we overestimated our manufacturing overhead, overestimated. The actual overhead is less than what we've estimated. That's good news. We like to have the credit balance is good news. More to come on that. All right, folks, the last step in our process, beginning finished goods from a prior period. If we have any that we haven't sold yet, they're available for sale, but we haven't sold it. Plus our cost of goods manufactured. That gets us the cost of all goods available for sale. Tell me what I did not sell, my ending finished goods, and I will tell you what I sold. Cost of goods sold, we know what's going on in the income statement. The ending finished goods is going on the balance sheet. All righty. So that's the process from beginning, getting your materials, working on it, labor and overhead, and then eventually having those units be finished, then we try to sell it. All right, so there's our flow. Okay, now factory overhead. You ready? What is our actual factory overhead consist of? Our actual factory overhead. Folks, that's not your direct, your indirect materials, your indirect labor, and then all costs associated with operating the factory. When you tell me, hey, Pete, rent, insurance, utilities, depreciation, hey, is that a product cost or is that a period cost? When you talk to me about rent, insurance, utilities, depreciation, certain salaries, how do I know if those indirect costs are period costs or product costs? Folks, if they're associated with operating the factory, if that's the rent, insurance, utilities in the factory, if that's a supervisor in the factory, if that's depreciation on factory equipment, then that's manufacturing overhead. That's a product cost. Conversely, if these same costs are occurring in the office building where the accountants and lawyers are hanging out, well, that's not going to be manufacturing overhead. That'll be part of your selling, general, and administrative. That'll be part of your SG&A, a period cost. All right? Costs occurring in the factory, those are product costs, not expensed until the product is sold. All righty? Now, the question becomes, how do we apply overhead? How do we estimate and apply overhead? How do we estimate and apply that overhead? What are we applying that overhead to? We're applying it to work in process. How do we do that? Well, step number one, I need your total estimated manufacturing overhead, total estimated, your budgeted manufacturing overhead. Divide that by your cost driver, your total estimated. Maybe it's going to be direct labor hours. Maybe it'll be direct labor dollars. Maybe it'll be machine hours. What we're trying to figure out is what is driving the numerator. What is driving the change in cost in the numerator? It's called a cost driver. We're looking for a relationship between the denominator and the numerator. Rob, you taught me that word, numerator. So we want to know what's causing the cost in the numerator. Is it machine hours, or is it labor hours, or is it labor dollars? We're trying to predict the change in the numerator given the change in the denominator. Okay, sensitivity. What is the manufacturing overhead cost most sensitive to? All right, more to come on that. All right, that gets you your manufacturing overhead rate. Your manufacturing overhead rate per hour or per dollar, whatever you used as the cost driver, okay? Whatever you used as the cost driver. Then what we do is step 2, once we know the actual hours, that period, the actual hours or dollars, we then multiply that by the manufacturing overhead rate we computed in step 1, and that gets you the manufacturing overhead to apply, which becomes part of our current manufacturing costs, our work in process. All righty, that becomes part of our manufacturing costs, our work in process. But you got to figure out what the cost driver is in that denominator. We want to choose a cost driver that has a high correlation with the costs in the numerator, okay? We're going to be looking for something called a correlation coefficient or coefficient of determination. We're looking for something that explains the change in the cost in the numerator. Is it the machine running? Is it people working? Is it paying the people? All right, we'll see how to do that. Exciting stuff. Now check this out. You ready? Look at this T account, manufacturing overhead. What's on the debit side? The actual. What's on the credit side? What we estimated in English. What we estimated. We thought we were going to have a cost of 16. What did we actually have? 2, 3, 10. The actual cost was 15. Hey, this is great news. We have a credit balance. The actual cost, 15, is less than what we budgeted, what we estimated, what we applied, 17. All righty. So since we estimated too much, we over-applied. We over-applied the overhead. So how do we then correct for that at the end of the period when you actually have the information for your manufacturing overhead, when you finally tally all those costs? What do you do with that under or over-applied? Well, we close it out to cost of goods sold. What would be the journal entry? You ready? We overestimated the cost, so we got to reduce cost of goods sold. We're going to have to credit that expense to reduce it. There's too much in there. And we got to get rid of this manufacturing overhead credit balance. How do you get rid of a credit balance? With a debit. So we will debit our manufacturing overhead, 2,000. We will credit our cost of goods sold, 2,000. Folks, when you see this journal entry, this is good news. Whenever you're crediting an expense, when your expense goes down, your profit goes up, and you're thinking, sweet, let's do it. And don't forget, your other manufacturing overhead is what? All miscellaneous costs associated with operating that factory. All righty. Rent, insurance, utilities, salaries, depreciation. If it's happening where? If it's happening in the factory, then it is a product cost, not a period cost, okay? It's good news when we overestimate the expense. It's bad news if we underestimate. Folks, if you're under-applied, don't memorize. Under-applied means what in English? We underestimated the expense. If you underestimated the expense, that means the actual has got to be greater than what? The estimate. That means we will have a debit balance. That is bad news. All righty? Sweet. All right, look at these beautiful, detailed, explanatory answers. My friends at UWorld took the time and effort, not only explaining why the right answer is right, but why the wrong answer is wrong. And again, reviewing the key points so you don't have to unnecessarily link back to the text. You could, we have that feature, but if somebody invests in the time and effort to put together these beautiful, detailed, explanatory answers, you don't have to waste time going back and forth. Look at how beautiful this is. So continuous production, the same or similar, homogeneous units, bags of flour, process costing, used when the units are what? Relatively inexpensive. And when we're going to trace the cost to specific units, that's very difficult versus job order. When tracing those costs to specific units is relatively easy when those units are relatively what? Unique. Large cost per unit. They're relatively unique. All righty. Now, why are we applying overhead again? The matching principle. We can't wait. We got to allocate overhead in a systematic and rational way. During the period, we have to apply the overhead to the units we're producing. We can't wait to the end of the period to figure out the actual cost. We can't. We got to assign the cost now. So in the interim, what are we going to do? Estimate it, apply it, and then eventually, when we figure out the actual amount, we'll make whatever necessary adjustment to the cost of goods sold. If we overestimated the expense, we'll reduce cost of goods sold with a credit. If we underestimated the expense, then we have to debit, increase the cost of goods sold, which will reduce our profit, okay? The difference between actual and applied overhead is called what? Under or over applied. Don't use the word applied. Think of the word estimate. All right, did I overestimate or underestimate the expense? Then it's logical, it's not memorized. All righty. Next question. Running out of coffee, this ain't good. Starting with the question stem. Rows, unfavorable, variable, overhead, efficiency, variance. Stop right there. Remember what I said. The variable overhead variances are set up the exact same way. Variable overhead set up same as what you got to do for your direct labor. All right, same thing you got to do for your direct labor. So look, actual hours times the actual rate. Then I want to compare that same actual hours but to the standard rate. Then I want to compare my standard hours allowed given my actual output at that standard rate. Exact same setup, whether you're doing variable overhead or direct labor, exact same setup, but you're going to choose whatever numbers are relevant, giving upon whether we're looking at overhead or are we looking at labor. So folks, variable manufacturing overhead only. If I'm only looking at the variable manufacturing overhead, the indirect materials, variable cost, the indirect labor, variable cost, the utilities, variable cost, the fixed manufacturing overhead would be things like more like the rent, the depreciation, the insurance. Those are your fixed manufacturing overhead costs, not all inclusive, but costs that do not change in total. Rent for the period, depreciation on the PP&E, the factory, the insurance, the total fixed cost within a relevant range is constant. We'll deal with fixed manufacturing overhead in just a little bit. Right now, we're looking at things like the indirect materials, the indirect labor, the utilities, okay? Your debit side is your actual variable overhead. Our credit side is what? The applied, in English, the estimated amount, okay? The estimated amount. So let's see what they tell us. The standard direct manufacturing labor hours per unit. So folks, this is the cost driver. For every hour somebody's in the factory, we are going to estimate a certain amount of variable overhead. It should take 2 hours, okay, for each unit we produce. 2 hours to produce each unit. Actual direct manufacturing labor hours. Here we go, 10,500, pop that in. Actual hours. The number of units produced, 5,000. Take the 5,000 units, actual output, times the standard per unit 2 hours. Folks, the standard hours allowed, we should have worked 10,000 hours. Okay, we actually worked 10,500. So I could tell you right now, the actual hours are greater than the standard hours. That variance is unfavorable, the efficiency variance. Okay, what else do they tell me? Let's see. The number of units produced, 5,000. Standard variable overhead cost per unit. You ready? $3 a unit is what we budgeted for our variable overhead, indirect materials, indirect labor, utilities, etc. So folks, that's a cost of $31,500. What was the actual variable overhead? Well, I don't know the rate. They did not give me that, but they gave me something better. The actual cost, $28,000. All righty. So let me work backwards. What is the actual rate for the variable overhead? You ready? We've got our cost of 28,000. Divide that by our actual hours, 10,500 actual hours. So folks, 28,000 divided by the 10,500 actual hours, that's a rate of $2.67 an hour per hour for the variable overhead. So $2.67. So folks, we budgeted $3. We only spent $2.67. We thought we were going to spend $31,500. We only spent $28,000. This is called your spending variance, folks. Spending variance, and that is $3,500 favorable. Okay, $3,500 favorable. All righty, that's not what they asked for in this question. They want the unfavorable variable overhead efficiency variance. Remember, just because you pay less doesn't mean you're getting something better. Sometimes you get what you pay for. All right, now my standard hours allowed, 10,000. What was my standard rate? Standard rate given information, $3, your budget. So folks, that's 30,000. All righty, we worked more hours than we should have. So folks, comparing these two pieces of the puzzle, my efficiency variance, because I worked more hours than I budgeted, 10,000, given the 5,000 units we produced, and we think each unit should take 2 hours, 10,000 hours is what we should have worked. We worked more than that. So folks, my efficiency variance is unfavorable. Unfavorable by how much? $1,500. Unfavorable, $1,500. There it be. All righty, then you can net it out. Your overall variance, variable overhead, your overall, well, you know what? Granted, we were a little bit less efficient, but man, did we save a lot of money. The 3,500 favorable, the 1,500 unfavorable nets out to 2,000 favorable. That's your overall variable overhead variance. All righty, $2,000. So we did all right, but that's not what they asked for. By the way, your T account, your actual variable overhead again, 28,000. What should it have been? What did we budget? The applied, 30,000. Okay, how did we get to 30,000 again? 5,000 units produced, 2 hours is what it should take, 10,000 hours at the standard rate per hour of $330. We have a $2,000 credit balance. Don't memorize, think. Your actual is less than what we estimated. We estimated 30, we only spent 28. That is favorable. Notice, there's your check figure. All righty, that is favorable. All righty, not so bad. Woo! All right, what about if they ask for fixed overhead variance? How do we do fixed overhead variance? Folks, if they ever ask you for the fixed, there is an E in fixed, right? Fixed overhead variance. How do we do that? Step one, I need a fixed overhead rate. I need my budgeted fixed overhead costs. Okay, things like your rent, your insurance, your depreciation, costs where the total remains constant within the relevant range, divided by your budgeted cost driver. In this example, that was direct labor hours. For every hour we work, this is what we think the fixed overhead would be. So that's going to be our cost driver, direct labor hours. Okay, so we get a standard fixed overhead rate per hour. Step one is complete. All righty, step two. So that is step one. You need your fixed overhead rate. Step two is a piece of cake. Take your actual output minus your budgeted production. Your actual output minus what you budgeted, your budgeted production. Multiply that by, from step one, your standard fixed overhead rate. Your standard fixed overhead rate. Standard fixed overhead rate. Folks, what you've just calculated, that is called your volume variance. Your volume variance. If your actual production is greater than what you budgeted, that is good news. That is favorable. You'd have a favorable volume variance. Okay, when your actual production is greater than your budgeted production, your budgeted output, your standard, whatever you budgeted. All righty. So that's how you do your fixed overhead variance. That is known as a volume variance. Get your fixed overhead rate, and then just look at your actual minus your budgeted production. Multiply that by your standard fixed overhead rate, and whoop, there it is, volume variance. Okay, here's our variable overhead variance. We could have looked at our T account for variable overhead. Variable overhead. The actual, 28,000, and then what we estimated, what we applied. The applied was 30,000. How did we get $30,000? The actual output was 5,000 units. Times each unit should take how long? 2 hours per unit is the budget. So we should have worked 10,000 hours is what we should have worked, the budgeted hours. Multiply that by $3 per hour. The standard variable overhead rate, which was given, the standard variable overhead rate, which was given information, $3 per hour, 30,000. We have credit balance, 2,000 favorable. Now, I remember at one time, when I was trying to, keep this stuff straight, sometimes you get a little bit nervous. You know what helped me? I'm right-handed. Are you right-handed? Because we like right-handed people. We favor right-handed people. That's right. Lefties, my poor mom was a lefty. We think lefties are odd. Folks, whenever your variance is on the right-hand side, that's favorable. We favor the right hand, we're right-handed. Now, if you're a lefty, you're all screwed up, but you already knew that you were all screwed up. All right, so when we have a variance that's on the left side, bigger than the right side, lefties, you're bad news. The righties are good news. All righty, so let's try another one. You ready? Take a second, set it up, and then we'll do it together. All right, stop. Did you start up here with Millen Company? Because you have no idea what to do with that. You should have started with your question stem. There's no working process. How many kilograms are we budgeted to purchase? Budgets. You ready? Step number one, when you do your budgeting, what drives the whole budget? What drives the whole budget? The sales budget is known as the driver. It drives everything. The sales budget. What do we think we're going to sell? We ask lots of people their opinion on what we think sales will be. We regress that against economic performance. Maybe if it's something expensive, do we think interest rates are going to be low such that they'll buy more? Competition. But we have to budget our sales. That's step number one. Drives everything else in the budgeting process. Once we know our sales budget, then what can we budget next? What do we need? What kind of production do we need to meet that estimated demand? And that's also going to drive our SG&A budget as well. Once you know your production budget, you're thinking, I'm going to need materials, I'm going to need labor, and I'm going to need manufacturing overhead. So now we can start estimating those amounts. Once you have all your manufacturing costs, your product costs, then you could start budgeting what? Your cost of goods sold. Once you budget cost of goods sold, you can budget your profitability. Now we have to figure out cash budget. We got to make sure we have enough money on hand to pay our salaries, rent, insurance, utilities, our workers, right? We got to make sure we have enough cash inflow, cash available to pay our debts as they become due. And if we're anticipating a cash shortfall, at least we can plan in advance to secure a line of credit at the lowest possible rate. But we want to know that in advance so we're not scrambling at the last minute. Folks, the last step in the budgeting process, your pro forma financial statements. All righty, remember, you got to do your income statement first because we need our profitability. Once you forecast your profitability, then you could forecast your ending retained earnings. Once you have your ending retained earnings, then you could do your BS. All righty, part of our stockholders' equity. All right, so we're budgeting what? Purchases of raw materials. That's based upon what? Production, sales. All righty, so we got to work our way up the ladder. So they tell me we're budgeting sales, stop right there, 53,000 units. Budgeted sales is where I start. Now, you want to have a cushion. You don't want to just make 53,000, and you may not even need to. You might have some stuff in beginning inventory, I don't know. All righty, but you want to make sure you have a cushion, some desired ending inventory just in case. So we add our desired ending inventory. And then you may not have to buy or manufacture that many units because you might have some beginning finished goods inventory. Last year's ending is this period's beginning inventory. That's my budgeted production. Okay, budgeted production. All righty, so my desired ending inventory of finished goods, a little bit of a cushion, a safety, margin of safety, just in case the demand exceeds my budget. And don't forget, you might have some beginning inventory of finished goods. Okay, your beginning inventory of finished goods. Let me put it that way. Beginning inventory, finished goods. All right, so we know our budgeted sales, demand, we're expecting 53,000. Now they tell me the manufacturer of 1 unit of NOIS requires 4 kilograms of lorry, I don't know, whatever that is. All right, that is my raw materials needed per unit of production. All right, let me see, do I have any beginning or ending inventory of finished goods? During October, we plan to reduce the inventory of law by 50,000 kilograms. That's the raw material change in inventory. We have too much. We want to reduce that by 50,000, but we want to increase our finished goods, the change in inventory for finished goods plus 6,000. I don't know my beginning inventory. I don't know, but whatever that number is, my desired ending inventory has to be 6,000 higher. So my change in finished goods inventory has got to be a plus 6,000. So I don't know whatever that number is. If it were 20 in beginning inventory, it would the ending inventory would be 26. All right, but the net change has got to be a plus 6. 53 plus 6, 59,000 finished goods we got to have. All righty. Now my budgeted production. Now I can move down the ladder. My budgeted production. 59,000 units. Okay, now what do I need per unit? 4 kilograms of whatever that raw material is, times the raw materials needed per unit. Well, the raw materials needed per unit, 4. 59,000 times 4. Total kilograms needed of this raw material, whatever the hell this is, 59,000 times 4. 236,000. Again, we want to have a desired ending inventory for raw materials, a cushion just in case, and then minus any beginning inventory of the raw materials. I do not know those exact numbers, but what I do know is that we currently have a surplus of our raw materials. Whatever our beginning inventory is, it's too high. We want to have a net change in raw materials. We want to reduce it by 50,000. All righty, so my desired ending inventory is going to be 50,000 lower than my beginning raw material. So if my beginning inventory were 250, then my desired ending would be 200. If my beginning inventory was, let's say, 175, subtract 50, we would want our ending inventory to be 125. Bottom line is a net change of 50,000. So 236 minus 50, the raw materials that we have to budget to purchase. 136 minus 50, 186,000 units have to be purchased. 186. Now I'm going to pretend, let's assume we have a cost per unit of 2. I'm making this up, folks. It's not in the facts. A cost per unit of 2. What am I budgeting my direct material cost to be this period? $372,000, right? Part of my cash budget. I got to make sure I have enough cash available to pay that $2 per unit. Excuse me, that $372,000 in total. Okay, I'm making up $2 per unit. Okay, just made that up. But you got to make sure you have cash available, $372. And don't forget the budgeting process. What drives the whole budgeting process? Your forecasted sales. Normally, sales are forecasted based upon a multitude of independent variables: economic performance, interest rates, competition, okay, whatever it is. All right. Now, just as an FYI, cost of our beginning inventory for raw materials, I don't know, but we just said we were going to purchase, assuming a cost of $2 per unit, $372,000. That would get my materials AFU, available for use. Subtract your ending inventory at cost. Don't know that number. And folks, there's going to be the cost of the raw materials used. Okay, if we have the numbers we plug in. Why is that important? Because then we would take our beginning work in process, if any, plus the raw material cost. Raw material used. What is that cost? Plus the direct labor, plus the manufacturing overhead applied, estimated during the period. These three are our current manufacturing costs. Add that to your beginning work in process. There's your total manufacturing cost. Subtract your ending work in process. And what do we have? Our cost of goods manufactured. The finished goods, the cost of the finished goods this period. All righty. And then where does that go? Beginning finished goods. Plus our cost of goods manufactured, cost of goods available for sale. Either you sold it or you didn't. Tell me my ending inventory of finished goods, and there's my cost of goods sold. All righty, got to know it inside and out, folks, that flow. All righty, so there's all our numbers, detailed explanatory answer, nice and pretty for you. Okay, the 186, and then I pretended it had a cost of $2 per unit to get that 372 cost. All righty, part of our cash budget as well. All righty. Now, the budgets are summarized by what? The master budget, a static budget, assuming one budgeted level of activity. What do we want to do with that master budget? Once you have the master budget, we want to break it down in what way? The selling price per unit. I want to know that. Okay, I want to know my selling price per unit. Then I want to subtract from that my estimate for my variable cost per unit. What does that get us? A subtotal. What the hell is contribution margin? What we have available to cover what? Total fixed costs. Contribution margin per unit times the number of units gets you the dollars available to cover your total fixed costs in dollars. Variable costs are constant per unit. Anything that's variable, sales, variable cost, contribution. Total fixed cost is constant in total dollars. All righty, and that gets us our operating income or net income, ignoring taxes and other costs. Okay, so that is called a variable income statement, variable method. We'll see more of that in just a little bit. You see, that helps me do this. I can then figure out, hey, what are my total fixed costs? My dependent variable, dollars, regressed against my independent variable, quantity. Within the relevant range, whether I produce nothing or I produce 1,000 units, whatever the relevant range is, there's my total fixed costs. My total variable costs are a function of my variable cost per unit times the quantity, the independent variable. There's my total variable cost. Total variable plus total fixed. There's your total cost. What's going to be very important is forecasting your sales. There's your forecasted sales. Where your forecasted sales intersects with your total cost, what's that called? Your break-even point, assessing risk. What quantity do I need to sell to just break even? Well, when you set up your variable costing format income statement, if you take your total fixed cost, divide that by your contribution margin per unit, that tells you your break-even quantity, your break-even in units, what you have to sell to just break even. If you sell to the left of that, you got a loss. You sell to the right of that, you're a winner, you got a profit. All righty, so it's all part of a bigger puzzle. You got to know how the pieces of the puzzle fit together. Okay, holistic approach as you do that final review. You should not be studying new content the week before or 2 weeks before you take the actual exam. The final couple of weeks, you should be completely in review mode, folks, review mode. All right, so there it is again, detailed explanatory answer, nice and pretty. All righty, now a regression model. You ready? What the hell is this y equals a plus bx? You got to be kidding me. Y equals a plus bs, not bs, bx. What's y? Your dependent variable. What's a? Your y-intercept. What's b? Your slope. What the hell is a slope? The sensitivity, the change in the dependent variable relative to the change in the independent. Change in total cost relative to the change in quantity. What's the x? Your independent variable. So this is total cost is a function of your total fixed cost plus your variable cost per unit in our setting times the quantity. Folks, that gives you this regression model. Total dollars, quantity, your y-intercept. This is your y-intercept. Your total fixed cost. What your total cost will be, even if you produce nothing in the short run, you still have a total fixed cost of y. That's your y-intercept. Okay, your total cost line is a function of your variable cost per unit, your slope, your change in total cost given your change in quantity. When you take that variable cost per unit and you multiply it by your quantity, now you have your total variable cost. Total fixed cost plus your variable cost, that gets you your total cost. All righty, they want to know, pray for this on the exam. What is the symbol for the independent variable? Your dependent variable is y, your independent variable is x. All righty. B times x is what? Your total variable cost. B times x is your total variable cost, okay? A is your y-intercept, y is your dependent variable. I want you guys to notice something, folks. We can see the trend and how people are answering the question and what the most common wrong answer choice is, which helps us better address which wrong answer choices obviously need maybe a more in-depth explanation, okay? So you could see where you are. All right, so not so bad. Let's see. I did want to point out one other item here. The change in the dependent variable, we're going to be seeing something called the high-low method, which is a method used to estimate your variable cost per unit given historic output. So this is your change in total cost, the high cost minus the low, divided by your change in quantity, the high quantity minus the low quantity produced. That gets you your variable cost per unit. All righty. So this quantity, by the way, what we remember that thing we talked about earlier, the cost driver, it's logical that change in quantity is going to cause, or is going to explain, I should say, change in total cost. Remember, your total fixed cost is constant, independent of quantity. That's why it's a straight line. Within a relevant range, whether I produce 1,000 units or no units, there's my total fixed cost. When you take your total fixed cost, though, and you spread it over more units, what happens to the cost per unit? It comes down. Okay, your cost per unit comes down. All righty. So that denominator, not the numerator, your independent variable, that is your cost driver. What drives the cost? Quantity. Whenever you have to choose a cost driver, when we do those overhead rates, when you got to choose a cost driver, choose the one with the highest correlation with the independent variable, with the dependent variable, the highest correlation coefficient. And sometimes if you take your correlation coefficient and square it, that's called your coefficient of determination. That is your correlation coefficient squared. That tells you the change in independent variable explained by the change in your independent variable. We want a cost driver that explains a lot of the change in the numerator, the change in the total cost. Woo, baby, look at that picture. What the hell's going on here, folks? If you got this on the exam, let's say this number right here was $1 million. That point right there is $1 million. Here's your dependent variable, total cost, dollars. Well, there's your total fixed cost, $1 million. Here's your change in your independent variable, change in quantity. There's your change in cost. That's how we will estimate our variable cost per unit. That's how we will estimate change in total cost, the high minus the low, change in quantity, high minus the low. That's how we will estimate that variable cost per unit. And then I will show you high-low method. Once you have your variable cost per unit, what we're going to do is then plug that in. Once you have that number, plug that in to your, I like to get high, so I'm going to say, and high on life, the high level of quantity. So I like to get high. I take my high level of quantity, I plug that in. I take my high level of total fixed cost and I plug that in. Okay, or excuse me, I plug in my high total cost. I plug that in. Let's say you know your variable cost per unit, make it up a number. Let's pretend that's 3. And let's say our quantity, high level of quantity, 10,000 output, $30,000. Okay, that's our total variable cost. Let's say we knew our total cost was $37,000 is our total cost. Well, then we could back into, because your total cost is the sum of your total fixed cost plus your total variable cost. If you know your total variable cost is 30 and your total cost is 37 minus 30, we can now infer that our total fixed cost is 7,000. From here on in, I can predict total cost by saying my total fixed cost within the relevant range is 7,000 plus variable cost per unit of 3 times any level of quantity within the relevant range. That's how I will predict total cost going forward. And we'll see that later. I got a question on that. Okay, folks, what I want to do next now I want to do a task-based simulation. Task-based simulation. So this is the one, let's see, I want to do. Yes, it is. Frosted Flakes. Freezed. I like it. All right, so let's exhale for a second. How we doing? Mad, talk to me. Rob, Rebecca, John, what's going on? You guys still with me, or am I talking to myself?
No, we're all with you. Hi, Peter.
What's going on? Are you loving this?
Yeah, it's great.
It's awesome.
People love what you're doing. Thank you.
I'm glad you're getting into some TBSs because we actually have received some questions asking for tips on approaching task-based simulations.
Look at this. You couldn't plan this any better. You would think we've done this before. You gotta love it.
Yeah, thank you.
Don't you feel bad for everybody who's not on our call right now? Like, we're all here enriching our minds and other people are like sleeping in or like going to the gym. Don't you feel bad for those people that they're not with us right now?
I cannot think of one thing I'd rather do.
All right, I haven't taken my medication yet this morning. All right, you guys ready? How do we do a TBS? Damn, even if it were an open book test, as I always say, the TBS would be challenging because of the monster volume of information they give you. First of all, calm down. You can and you will do it, but you got to use good technique. What's the good technique? You know what I call it? Legalized cheating. Before you read all these facts that you have no idea what the hell to do with, let's cheat, look at our questions, set it up, Then we can read our facts in context, okay? So let's see if we got any legalized cheating we could do here. So I'm not even gonna look at that yet. Let me look at my questions. All righty, they wanna know, what's the budgeted cash payment for material suppliers? Okay, I'm gonna have to look at what I'm purchasing. I'm gonna have to look at what the cost per unit is, and then when I pay the bill, we'll see that. Variable costing, absorption costing. Stop right there. Hey, I know how to do this. What's variable or direct costing? Remember, variable costing, I set it up. I take my sales minus my variable costs, contribution margin. In English, the money I have available to cover what? Fixed costs. And then there's your profit, your operating or net income, depending upon whether they give you taxes and interest, which they may or may not. Okay, that's very useful for internal decision making, But folks, externally, we got to use GAAP. Now, in financial accounting and reporting, we don't call it absorption, but that's what GAAP is, the absorption income statement. Sales minus what? Cost of goods sold, right? All your product costs. You get a gross profit, then minus your SG&A. That's how you get your operating income. And these may not be the same. They may or may not. The difference in net income between these two income statements, the difference in net income, you got to find for me the change in inventory. Did it go up or did it go down times the fixed manufacturing overhead per unit? That is the difference in income. Your fixed manufacturing overhead under variable costing, this is treated as a period cost. We expense it in its entirety, that fixed manufacturing overhead. We treat it as a period cost, all righty? Whereas under absorption costing, that is a product cost, expensed only if product sold. That's the only difference, folks, in net income. So you could forecast, find me the change in inventory. Did it go up or down? Tell me the fixed overhead per unit, and that's how we'll get the difference. Okay, they tell us actual results are as budgeted, except only 60,000 of the 70,000 units are sold. What's that going to do to our net income under the absorption method? All right, so we're going to have to adjust our income statement for having fewer sales. We'll see how to do that. We've got a special order. Should we accept this special order, 5,000 units of the frosted product? Well, that would cause a loss of 1,000 units of regular sales. That's called an opportunity cost. If we accept this special order, I'm going to incur this opportunity cost. Should we accept it or not? I'm thinking, what did I learn about special orders? I'm going to accept if the revenue is greater than the relevant costs, not all costs, the relevant costs, the incremental, the ones that change, the marginal. The relevant costs will be your variable costs plus any lost contribution margin. Okay, if you have excess capacity, folks, which we don't have here, but what I'm thinking is if I had excess capacity, okay, there would be no opportunity costs. I don't have to give up anything else to produce these extra 4,000 units. But if there's no excess capacity, well, that's when you got a problem and you're going to have to give up something to make this special order. No excess capacity, that's when you have opportunity costs. We are going to have, folks, opportunity costs here. It's your loss contribution margin. All righty, on those 1,000 units that I can't produce, tell me the contribution margin per unit, and I will tell you what that portion of my relevant costs are. Okay, what is the minimum price we are willing to assign to this new product, rounded to the nearest penny? Well, obviously, anytime you have a new product, you got to make sure your selling price is greater than what? Your cost. But not only do you want your selling price to exceed your cost, you'd like to make what? A profit. All righty, so we're gonna have to see, well, what's the desired profit? We'll get there. All righty, what else do we got? We got, let's see, question number 7, what's that about? determine whether we should make or buy. Lowest cost. I like the lowest cost. Very simple. I will make it if that cost to make is less than the cost to buy. All right, so the cost to make it. Now, what are my relevant costs to make it? Your relevant costs to make it. All righty, that's things like what? Your variable costs, your direct materials, your direct labor. Folks, variable costs change as you produce more or less. That's always going to be relevant. Fixed costs may or may not be relevant. Fixed costs, I need to know, is it controllable or uncontrollable? Avoidable or unavoidable? Variable costs plus avoidable fixed costs. Okay, that's relevant. So folks, variable costs are going to be relevant. Sunk costs are not relevant. Costs that have already been incurred, cost of a study, cost of R&D, forget it. All righty. Fixed costs, usually, absent any other information, they don't change. If they don't change, they're not relevant. So variable costs are relevant because they change with quantity, quantity up, quantity down. Total fixed costs, I need to know, is it controllable, also known as avoidable? If so, that is relevant in my decision-making process. If it's uncontrollable or unavoidable, that I'm going to ignore. That is not relevant. Ignore it. All righty. Next item. Should we sell the product or process it further? So at the split off point, okay, should we sell it now or process it further? Well, process further if what? Well, tell me the incremental revenue I'll get from processing it further. Tell me that incremental revenue I'll get if I continue to manufacture and process further, but also tell me what's the incremental cost of processing further. Okay, also known as separable costs. That's what's relevant when you do that, sell it now or process further, okay? Now, should we keep or eliminate a product line? Wait a second, I learned about keep or eliminate. You remember, in the short term, sometimes you're losing money. Sometimes in the short term, the short run, you're losing money. But that does not mean you should immediately drop the product line. You should immediately drop that product line because there are going to be some costs that in the short term are unavoidable. So I'm going to drop it if the benefit of dropping exceeds the cost of dropping. Folks, if you drop it, you're going to lose any contribution margin that you were getting from that product. Remember, you've got your sales minus your variable costs, your contribution margin. Here are your fixed costs. There's your operating income. We know that this is a loss, okay, but I need to know, are those fixed costs avoidable? Can you avoid it? Or are they unavoidable? Unavoidable. You don't want to make bad news worse. You don't want to increase your loss. So folks, the cost of dropping it, you will lose your contribution margin. What's the benefit of dropping it? You're saved your avoidable fixed costs. If the avoidable fixed costs are greater than, that's your benefit of dropping. If that's greater than your lost contribution margin, then we'll drop it now. Otherwise, you'll drop it when all costs become variable. In the long term, all costs eventually become variable. It's in the short term, whether they're fixed or not. The rent, you might have a 10-year lease. So you're locked in. You personally guaranteed the rent. All right, you're locked in for 10 years. Doesn't mean you shouldn't shut down the business right now, but that's an unavoidable cost you got to consider when making that decision. All right, so I set it up. I did my legalized cheating. Now I can read the facts in context, and I kind of know what the hell to do with everything. All right, so here we go. They tell me fauna and flora. F&F is a food producer, has several divisions encompassing many aspects of the food and production, from developing new varieties of plants and domestic animals. I don't know what the hell they're talking about. They just launched a new product. We got a new product, Frosted. It is looking at the costs and cash flows from that product. All right. Then they've got F&F is starting the process of pricing a new product. What should be the price of this new product, Freeze? As a starting point, they're looking at cost plus pricing. They have a standard minimum markup. Folks, they want a 20% profit margin. They want a 20% profit margin. So this is what I would do before I keep reading. What the hell does that mean? Do something with this. You ready? This is going to tie to question number 6, all right? That Freeze product, what should we price it at? So for question 6, this is what you do. Let's say your selling price is 100. Here are my costs. We just said we want a gross profit of what? 20% or 20. That means your costs are 100 minus 20, right? 80. So that's the first thing you do, given a profit margin of 20%. Okay. Now what I want to do next is take my profit that I want, 20, and what is that relative to my cost of 80? 25%. While your profit is 20% of your cost, while your profit is 20% of your selling price, your profit is 25% of your cost. Think about it. Selling price is equal to your cost, 80, plus your profit. My profit is 25% of my cost, 80. What's 25% of 80? 20. 80 plus 20, selling price is 100. So folks, your desired profit, that desired profit of $20, 20%, that's 20% of your selling price, but that same number is 25% of your cost, 80. All right, 25% of your selling price, which is 100, or 25% of your cost, okay? So we're gonna do cost plus pricing. So I'm gonna need my cost per unit. My selling price will be my cost plus 25% of whatever that cost number is. That's gonna be my selling price. Not because I memorize a formula, but whatever my profit, look, what if they told me you want a profit margin of 30%, selling price 100, cost, if I want a profit margin of 30%, then I put a 30, then my cost is 70. While my 30 is 30% of my selling price, that's gonna be a different percent of my cost. Okay, your selling price is gonna be your cost plus a certain percentage of that cost, which then gives you the desired percentage of your selling prices you're gonna save. All righty. The dairy division needs 20,000 barrels of cheese culture. If F&F buys the culture rather than producing it, if they buy it, the cost to buy, rather than making it, they can eliminate $2 of fixed overhead cost per unit. Folks, what is that $2 per unit? That is relevant. That is an avoidable fixed cost of $2 per unit. That is relevant, folks. That is relevant for decision making. Let's see, the cost to buy it is 44. So I have all that I need to do that question, the cost to buy versus the cost to make it. The make or buy, folks, that was question number 7. The make or buy, I would cross-reference and say, oh, which one was that? Oh yeah, I need that for question 7. All righty, that was this question here, the make or buy. Okay, sorry about that. Let's go backwards. What else do they tell me? The aquatic division uses a joint process. Joint costs are all costs up to the split off point. So when you see joint costs, you don't think of the cost of a joint. That's not what we're talking about, not that type of joint. All costs up to the split off point, those are your joint costs. All costs after that, separable costs. So they tell me each product can be sold at the split off point or process further. That was that question. Sell it now or process it further. We will process it further if the incremental revenue exceeds the incremental cost. The joint costs are up to the split off point. They are not relevant in this particular decision. So the joint costs are not relevant. They've already been incurred. Already incurred. They are not relevant in this particular decision. All righty, so this is going to be questions 8 through 10, and I'll also play with the joint cost, show you how to allocate it in a different type of question. All right, then management is thinking about eliminating the fresh product line because it's a loser. It's losing money. Does the benefit of dropping it, the saved avoidable costs, fixed costs, outweigh the cost, the loss contribution margin? Okay, and then I want to cross-reference that. That's question 11. All right, now I got my roadmap. All right, I got my roadmap. So let's see what we got. I go to my given information. Ready? Here's my given information. So question number 1, all things being equal, cash payments to materials during the period. What's the period for the frosted product? So I got to pay for those materials. So let's see what we got. Frosted product. All right, here is the budget for the frosted product. The period is defined as 10 weeks. Notice the period could be for the month, the quarter, the year, anything they want. Here it's 10 weeks, whatever. That's their 10-week period. All righty, so I need my cost for materials. So they give me the selling price. The cost for materials is $3 a unit. Don't care about the overhead, the conversion cost. Don't care about the SG&A. Beginning accounts payable. So I got to pay the $40,000 beginning accounts payable. Got to pay that. And then we're going to have manufacturing and sales of 70,000 units that are going to occur evenly over the period. Now, what's the period defined as? The period is defined as 10 weeks. All right, materials are paid for. Here we go. They got to tell you, given information, reading comprehension. When do we pay for this? Do we pay cash or do we pay down the road? Well, they tell me they pay for it in the week following usage. All right, so I need 70,000 units. My period is 10 weeks. That's 7,000 units per week at a cost of $3 per unit. $3 per unit, agreed? But I'm not going to pay for all 10 weeks this period, because what I buy in the 10th week will be paid for in the 11th week, right? What I pay for in the first will be paid for in the second in the period. What I buy in the second will be paid for in the third, still within the 10-week period. It's only when we get to the 10th week that won't be paid in this 10-week block of time. So folks, I'm going to pay $40,000 plus 7,000 units times $3 a unit, but times 9 weeks. That is going to be my cost for materials in this 10-week block. So I go back to question number 1. I want to answer question number 1 now. All right, and I'm actually going to do it here where it's nice and neat. Let me jump ahead where I haven't messed it all up yet. All righty. So I am going to pay my beginning accounts payable. I got to pay off 40,000 plus 7,000 units per week times a cost of $3 per unit, but I'm only going to be paying for 9 weeks in this 10-week period of time. How do we define the period? 10 weeks at a time. That's the key to getting this right. And that's just reading comprehension. So 7,000 units times $3 a unit, that's $21,000 per week, but not all 10 weeks are going to be paid for in this period. I will pay the first 9 out of the 10, 189. 189 plus 40, 229. What's going to be your ending accounts payable? What will be our ending accounts payable, folks? The 1 week, 7,000 units times $3 per unit, $21,000. All righty, $21,000. That will be my, if they asked for it, that would be my ending accounts payable in this 10-week block of time. Normally it's for the month or the quarter or the year. Hey, every period is 10 weeks. You could do whatever the hell you want. Remember, folks, reading comprehension. This was not a function of knowing any particular formula. All right, it was just reading comprehension. All right, now let's do question 2, variable costing, absorption, and let's do that for the frosted product. So back to that same given information. Here we go. Back to that same given information, frosted product. There we go. There's the frosted product. So we go back to that. How do we do variable costing again? Ready? Variable costing versus absorption costing. You ready? They tell me selling price $11 a unit. Materials, that's a variable cost. Conversion costs are what? Your direct labor plus your manufacturing overhead. Now, folks, direct labor is a variable cost. Manufacturing overhead, there's two types. There's the variable costs, the utilities, the indirect materials, the indirect labor, and then the manufacturing overhead has a fixed cost. All right, so let's get this all straight. So I got my direct materials, a variable cost, that's 3, given information. Okay, direct labor, let's see, they didn't give it to me. They just gave me conversion costs. Remember, your conversion costs are your direct labor plus your manufacturing overhead applied, the sum of those two. Okay, the variable portion is 2. I don't know how to break that out between the direct labor and the manufacturing overhead, but that combination is 2. The fixed manufacturing overhead is $210,000. Folks, I need to know how many units am I manufacturing? I'm manufacturing and selling 70,000 units. Take that fixed cost, $210,000, divide it by 70,000 units that I am manufacturing. That's a fixed overhead cost per unit of 3. Okay, stop right there. Something very important in this sentence here. Manufacture 70,000, you're going to sell every unit you manufacture. Folks, there's no change in ending inventory. When there's no change in your ending inventory, then if we do this correctly, your absorption net income should equal your variable costing, your direct costing net income. Direct costing. Variable costing, direct costing. They should be one and the same if we do this correctly. The only difference is the treatment of fixed manufacturing overhead. Fixed manufacturing overhead. Under variable costing, the 70,000 times 3, all $210,000 is going to be a period cost. It all gets expensed. Under GAAP, the absorption, you got to tell me the number of units sold, which happens to be 70,000, times that fixed manufacturing overhead per unit, the 210,000 given information, things like rent, insurance, depreciation, divided by the 70,000 units we manufactured, that's a cost of $3 per unit. And that's based upon the number of units we manufacture, 70,000 units. Well, I'm selling all 70,000. So folks, under both methods, we are going to expense all $210,000 under both methods. That's why the net income should be the same. All right, let me do my normal, my absorption, my normal GAAP income statement. My sales, my number of units sold, 70,000, times my selling price per unit, 11. Here's my sales revenue, $770,000. Now I want to subtract my cost of goods sold. 70,000 times, what is my product cost per unit? What is my product cost per unit? My product cost per unit. I got my direct materials, plus my direct labor, plus my variable overhead, plus my fixed overhead. There is my product cost on a per unit basis. All manufacturing overhead, fixed or variables of product cost under US GAAP. So my direct materials given information, 3. My direct labor, I don't know. I just know that my labor and my variable overhead, those two items are $2, and my fixed overhead, $3. Add it all up. 3 plus the 2 plus the 3, my product cost per unit. Product cost per unit, $8. 70,000 units times 8, my cost of goods sold, $560,000. 560. I've got gross profit therefore of 210,000. That is my gross profit. Now I got to subtract out my SG&A, variable as well as fixed. So I've got the fixed portion. So I'm just going to move my gross profit here. My SG&A, my variable SG&A, $1 a unit, 70,000 times 1, $70,000. My fixed SG&A, that is $45,000. My net income or operating income, net income, if you ignore taxes, interest, $95,000 under US GAAP. Using a regular GAAP income statement, which is what's required for external financial reporting. But for internal decision making, we would rather use variable or direct costing. Variable or direct costing. That is not allowed externally, but it certainly is helpful internally. How do we do variable direct costing? You take your sales, 70,000 units times 11, no change, 770,000. Now I want to subtract out all my variable costs, just my variable costs. Direct labor, let's do direct materials first. Direct materials, 70,000 times 3, 210. Direct labor, variable overhead, I know those two combined, 70,000 times 3, that's a conversion cost, and that should be 2, sorry about that, right? The direct labor, variable overhead combined, 2, 70,000 times 2, 140,000. And then my variable SG&A, 70,000 times, what was my variable SG&A? Variable SG&A, $1 a unit, 70,000. This tells me what I have available to contribute towards the coverage of fixed costs. 770 minus 210 minus 140 minus 70, 350,000 is what I have available to contribute towards covering my fixed costs. Now I subtract my fixed costs, my fixed manufacturing overhead, my fixed overhead being treated as a period cost, 210,000. And then my fixed SG&A, 45,000. Subtract that out. Net income, if we did this correctly, do we get 95,000? Yup, exactly the same. Why is it the same? Because there was no change in ending inventory. Let's say ending inventory went up. Let's say we manufactured 70, but we only sold 10,000 units. Let's say the change in ending inventory was a plus 10,000 units. If ending inventory goes up by 10,000 times $3, your fixed overhead per unit, your fixed manufacturing overhead per unit, the difference in net income would be $30,000. If ending inventory, if we manufactured 70, but we only sold 10, if my ending inventory went up by 10,000 units, multiply that by the fixed manufacturing overhead per unit, $3. Your difference in net income will be 30, but who has the higher net income? Well, think about it. Under GAAP, that fixed overhead is only expensed if the units are sold. So your GAAP net income would be higher. GAAP net income would be higher than your variable based by 30,000. Because that $30,000 cost under US GAAP is sitting on the balance sheet as part of ending inventory and does not get expensed until the product is sold, okay? Now, let's see what else we got. On a per unit basis, folks, selling price per unit, $11. My variable costs on a per unit basis, we had the direct materials of 3, the direct labor and the variable overhead, I'm going to put those on the same line. Direct labor and variable overhead, that was 2. And then we've got our variable SG&A, which was 1. So folks, 3, 2, 1, 11 minus the 6. We've got a contribution margin per unit of $5. Now, how is that helpful in decision making? Because if you took your total fixed costs and divided it by your contribution margin per unit of $5, that tells you the number of units you got to sell to break even. Or if you took your total fixed costs and divided it by your contribution margin as a percentage of sales, my contribution margin is 350, my sales are 770,000. That's approximately 45%, approximately. If you divide your total fixed cost by 45%, that tells you what your sales dollars have to be to break even. That's why this direct variable costing is so valuable. All righty. But now we can answer questions 2, 3, and 4, or at least 2 and 3 with this setup. All right. So let's go back to our answers. Under variable costing, what do we think our net income is going to be? 95,000. Under absorption costing, what do we think it's going to be? 95,000. Why is it the same? When you manufacture and sell the same amount, there is no change in ending inventory. Therefore, we predicted earlier that those would be the same. Okay, they tell us now actual results are budgeted, except that only 60 of the 70,000 units produced were sold. Now, ending inventory is going to go up. Okay, ending inventory is going to go up. They want to know, under absorption costing, what would your difference in net income be? All right, when we sold, we know that that's 95,000 when we manufactured and sold all 70,000. Okay, all 70,000. Now it's only 60,000. Now it's only 60,000. Ready? 60,000 units are sold. So if we do absorption, how do we do it? First thing we need, selling price, $11 a unit. So my sales, 60,000 times the $11, 660,000. Cost of goods sold, 60,000. What did we say our product cost was per unit? Our product cost per unit. Product cost per unit. We've got the direct materials, direct labor, plus the variable overhead, plus the fixed overhead, 3, 6, 7, 8. $8. $8. So 60,000 times 8, cost of goods sold, 480,000. Let's take our 660, back out our 480,000. So 660,000, 480. I got 180,000 gross profit, 180,000. All righty. Now we've got our fixed SG&A. Fixed SG&A, which was what? 45,000. And then we got our variable SG&A. 60,000, I believe that was $1 a unit, right? So 60. So 180 minus the 105. 75,000. All righty, so we got a difference of $20,000. A difference, they want the difference. 20,000. All righty, difference of 25,000. Now, question number 5, that special order. Okay, I'm thinking again. I'm going to accept my special order, except if your sales revenue is greater than your relevant costs. Now, what are my relevant costs? My variable costs and any loss contribution margin. Are we going to have loss contribution margin? Yes, we are. Why are we going to have loss contribution margin? Because that 1,000 units I have to give up. There's my opportunity cost. 1,000 units times that contribution margin per unit. All righty, so my loss contribution margin. Let's go back. Frosted product again. So please go back to the given information. And hopefully you took a picture of that. My contribution margin per unit, $5. There's my contribution margin per unit. Okay. My variable costs for the frosted product are the direct materials plus the direct labor plus the variable overhead, also $5 a unit. So now let's go back to our setup. We've got a contribution margin of $5 a unit. So I'm going to lose this contribution margin because I got to give up these 1,000 units to make those other 4,000. Those 4,000 times my variable cost per unit. Okay, my variable cost per unit. So one more time, what was our variable cost per unit that we have to cover? So we've got the direct labor, the variable overhead, 345, plus my variable SG&A, which was $1. So my variable costs are 3 plus 2 plus 1. Total variable costs, 6. That's the 3 plus the 2 plus the 1, 24,000. Add it together, we've got to have sales. Okay, we've got to have sales of at least what amount? $29,000 in total. $29,000 in total. Now, folks, if you take those $29,000 in total and divide it by the 4,000 units, we could get a selling price per unit. I believe that is $7.25 would be your selling price on a per unit basis. Okay, that would be your selling price on a per unit basis. All righty. So 725, but we got to have sales of 29. Okay, let's try number 6. What is the minimum price we should assign to the new product freeze? Now that's the cost plus pricing. Okay, so let's go to the freezed. Where is the freezed? Freezed. Okay, we said we want a profit margin of 20%. So how did I set it up again? Selling price 100. I want to have a profit of 20. That means my cost is 80. Okay, my profit is obviously 20% of my selling price, but 20 divided by 80, it's 25% of my cost. So if I know my cost, which I do, direct materials, direct labor, variable overhead, fixed overhead. Add it all up. There's my cost per unit. Cost plus pricing. My selling price, I got to cover my cost, plus I want my profit. And my profit is my cost times not 20%, but 25%. So my selling price is $367. My profit, 367 times 25%, that's 92 cents. 367 plus 92 cents would get me a selling price of $459. Now, folks, check yourself. If you've got a selling price of $459, I want 20% of that to fall to profit. What's 20% of $459? 20% of $459, whoop, there it is, 92 cents. And then my cost, $367. If you had to back into it, $459 minus the 92 cents, there's your cost. So if you were given the selling price and you were given your profit margin, well, then you know with a profit of 92 cents, your cost would have to be $367. All righty. And then you could also check yourself, is my cost $367? Okay, what's my profit? 0.92. Is the profit 25% of the cost? You bet it is. That's 25%. We are in good shape. You do not need to memorize formulas, folks. Whatever profit margin they give you, you just plug it in right there and then you follow the same approach. There's nothing to memorize. Okay? This 92 cents, while that 92 cents is 20% of your selling price, that same 92 cents is 25% of your cost. All righty. Once they tell you you want a 20% profit margin, then I want to have profit of 20. Then 20 divided by my cost, 80. Well, 20 divided by 80 is 25%. If they told me, hey, I want to have a profit margin of 25%. Selling price 100, I want to have a profit margin of 25%. Okay, profit is 25%. Then my cost is going to be 75% or 75. Then my profit as a percentage of my cost, 25 divided by 75, 33%. All right, then multiply that by your cost per unit. Therein lies your profit. Your selling price is your cost plus your profit. So if I change the facts, but my cost per unit stays the same, but now I want a profit margin of 25%, 367 times 25%, 367 times 25%, let's see, excuse me, 367 times 33%, 367 times 33%, $1.21. $1.21. 33% of 367 is $1.21. That would be my profit. And then $1.21 plus 367, my selling price would have to be $4.88. All righty, so there's nothing to memorize. You can reason your way through it. So that was question number 6, cost plus pricing. So now we can put our answer in there. What did we say it was after all that again? $4.59 is our selling price. So $4.59. All righty, we are kicking ass, baby. Hang in there. You ready? Question number 7 now. Question number 7. Cheese culture. Where the hell am I going? I got to go back here. Okay, the cheese, make it or buy it. So now let's go to our given information for cheese. I got to find the cheese, please. Where is the cheese? Cheese. Cheese facts. Cheese, make it or buy it. Where is the cheese? There it is, cheese. Question number 7. You ready? Make if cost to make is less than the cost to buy. Now this was given information, folks. In the facts, the cost to buy was 44. In the given information, they also said the avoidable fixed costs, if you guys remember, and I'll show you where that was. Sorry about that. Come on. The avoidable fixed costs back in the given information for the cheese. There it is. Let's see. The dairy division, we need the cheese. We can eliminate $2 of fixed overhead cost per unit. So that's relevant. That is an avoidable fixed cost. So let's go back to the cheese. I got avoidable fixed costs of $2. What other costs are relevant costs? All your variable costs. Direct material, variable. Direct labor, variable. Variable overhead, all my variable costs. All righty, my variable cost, 16 plus 16, 32 plus the 8. My variable cost is 40. All righty. So my relevant costs to make. My avoidable fixed cost of 2 plus the variable costs of 40, my relevant costs of $42. The cost to make it, is that cheaper than the cost to buy? Yes, it is. So what are we going to do with question number 7? Make it. Make it for $42. The 48 distractor information, the $8 of fixed overhead, if it's uncontrollable, the fixed overhead, 6 was unavoidable. 2 was avoidable. That was all that was relevant, the 2. The manufacturing cost per barrel of cheese for 1 barrel, that is distractor information. All right, most people think, hey, the cost to make it would be 48. No, the relevant cost to make is only 42. Cost of that $8 cost, 6 was unavoidable, 2 was avoidable. All right, so 2 is avoidable. So very important, folks. You got to know what costs are relevant, which costs are irrelevant. Okay, the costs that are relevant. What are some synonyms for relevant costs? Relevant costs are sometimes called marginal, sometimes called incremental. Obviously, they change. Sometimes they call it, if it's a fixed cost, they'll call it controllable, or maybe they'll call it avoidable. All those costs are going to be relevant, as well as opportunity costs. Those are all relevant, okay, when you make decisions. So whether they call it marginal, incremental, they change, controllable, avoidable, opportunity. What's irrelevant? Sorry about that. What's not relevant? Sunk costs. Sunk costs. The money's already been spent. Already been spent. If it's already been spent or committed, it's unavoidable. Unavoidable is also known as what? Uncontrollable. Folks, when you see fixed costs, read carefully. Fixed costs, when they say nothing, then it's uncontrollable. If there are fixed costs that are avoidable or controllable, they'd have to tell you that. Otherwise, you'd have no way of knowing. Okay, so when it comes to fixed costs, you got to read carefully. Absent any other information, not relevant. Unless they tell you avoidable or controllable, then it's relevant for decision making. All righty. Now let's see, what do we got next? Now we got to do, so that was make it. All right, so we're going to make it. Make it $42. We're going to make it. All right, so that was question number 7. All right, questions 8, 9, and 10. We got to go, let's see, 8, 9, and 10. We got to look at sell or process further products A, B, and C. There we go. Sell or process further. How do we know what to do with the sell or process further? What's the rule? Process further if. Process further if incremental revenue is greater than the incremental cost. And folks, if you break even, then you got to consider other factors like, is this a product a major customer wants? Even though it doesn't by itself make us a profit, given that it's a major customer we want to please, or maybe it's a barrier to entry, we don't want a competitor to make this for them, because then that competitor might upsell other products that we want to sell to them. So if it's break even, you got to consider other factors, okay? But is your incremental revenue greater than your incremental costs? Okay, joint costs are ignored. We learned in the facts here, the joint costs are $200,000. We ignore that in this decision. We ignore this. Why? That money has already been spent. Those are all the costs up to the split off point. Okay, what we want is the separable costs. That's relevant for this decision, the incremental, the separable costs, the costs after split off. Okay, that's relevant in this process. So I got 3 products, A, B, and C. All right, for product A, right now it's split off, we could sell it for 75, but if we keep working it, we could double that and sell it for 150. So 150 minus 75, what's my incremental revenue? 75. Is that greater than my additional product costs? These are your costs after split off, your separable. So these are after split off. Okay, we're ignoring the cost of that joint. So 75, is that greater than 30? Confidence building question. Yes. Process it further. Okay, so process further, no doubt. We will add to our net worth. How about product B? We could sell it right now for 150 or keep working it. Work it. You got to work it. Who was that? Not Mary J. Blige. That was, who said work it? You got to work it. Come on. Rob Bass, who sings you got to work it? Oh, man, I'm thinking of her name. Mary J. Blige. Who's the guy work? Ah, damn it. All right. That's who is it?
Missy Elliott.
Missy Elliott. There you go. That's 30. All right. 180 minus 50, 130. What's the incremental cost? 30. So this is a maybe. We got to look at other factors. We got to look at non-financial factors. The financial factors, we're going to break even, but that alone, we got to look at non-financial factors, folks. Is this an important client we want to keep happy? All righty. Product C. Incremental revenue, we could sell it right now for 30 or double it. 60 minus 30, incremental revenue 30. And what's the incremental cost? No way, can't do that. No, sell now, sell at split off. Do not process further. Do not process further. That would be a loser. Don't do it. Sell it now. Okay, so that answers those 3 questions. We are gonna yes for A, maybe for B, no for C. All righty, now I want to review with you, how do we allocate joint costs to the main products, not the byproducts, not the incidental, the main products. So how do we allocate joint costs? All the costs up to split off, you could do it in one of 3 ways, based upon pro rata volume, or if there's a sales value at split off, use it, sales value at split off, or if no sales value at split off, or you want to do it another way, you can use net realizable value. I don't have volume, folks, but I got 2 and 3. I got sales value at split off. All righty, so how would I allocate my joint cost to products A, B, and C? Product A, that's 75 of the 255. 75 of 255 times the joint cost, 200, 58,820. Drop the zeros so you can move more quickly. Product B, that's 150 of the 255 times the joint cost of 200, 117,650. 117.65. Product C, you're only 30 of that 255 times 200, you would get 2553. Now, folks, check yourself. If this doesn't add up to $200,000, you screwed something up. Now, there might be rounding, but is it close to 200? Yes, it is. That's how we would allocate the joint cost to the main products. Remember, you do not allocate the joint costs, the common costs. Okay, you do not allocate those to the byproducts, just the main products, the joint products. Okay, or another way to do it is what we call relative net realizable value. How do we do that? You ready? We got to allocate the $200,000 of cost. Generally, you'll use this if the sales value at split off were not known. Okay, were not known. Then this is a way you can allocate. If you can't, if you don't finish it, it's worth nothing. All right, what are you going to do with a partially completed sock, right? So you got to finish it to be able to sell it. So then this is what we would do. Relative net realizable value. I'm going to take my final sales value, 150, minus the additional cost to finish it, 30. Net realizable value, your final sales value minus your incremental cost, that's 120. For product B, final sales value. For product B, 180. But you got to spend 30 to get that, 150. Product C, you'll have a final sales value of 60, but you got to spend 45 to get that, that's 15. The net realizable value, the final sales value minus the cost to complete. Net realizable value, net means subtract. Final sales value minus that incremental cost to complete. 120 plus 150 plus 15, 285. 120 divided by 285 times the joint cost. Joint cost 200, 84.21. 150 divided by 285 times the joint cost, 105.26. 15 divided by 285 times the joint cost of 200. What are we going to assign to product C? 1053. If you did it correct, it should add up to what? 200. And that's the way to allocate your joint costs. Remember, your total cost is your joint cost plus your separable cost, the costs incurred after the split off. That's your total cost, all right? Joint cost. Speaking of a joint cost, I got to go out to California, man, and I'm just curious, which city smells more like weed? Is it going to be San Francisco or New York? I'll let you know shortly, because I know you can get high for free in New York. All you got to do is walk around any street. Now, I'm just curious, all this smoking of weed, what is that doing to the passing rate on the CPA, the bar exam, your medical licensing exams, your CFA exam? Are people doing better or worse as a result of all this weed smoking? I'd like to know. I think I'm gonna research that. Rob, would you happen to know the answer to that question? Rob doesn't know the answer to that question. Rob don't smoke no damn weed. All right, we got another question.
I do not know the answer to that question, Peter.
You do?
I do not.
Oh, all right. Well, we're gonna research that.
I wanted to jump in to help you.
All right, question number 11, our last question. What the hell was our last question? Fresh product line, should we chop it? Look at this. Let's go back to our facts. This one was for question number 11. Question number 11, we got a loser. Which product line is a loser? Fresh is losing money. So no doubt about it, folks, in the long term, I'm getting rid of Fresh. We're going to eliminate it in the long term because it's a loser. The question is, what about in the short term? Does the benefit the saved, avoidable, fixed costs outweigh the cost of dropping your lost contribution margin? If you drop this, you're not going to have that $1,500. That's gone. You ain't going to have that. It's gone. You stop making a product, you're not going to have that. But you cannot eliminate all fixed costs right now. What costs can you eliminate? Let's see. The portion that's avoidable, that's relevant. I can only save 300 is not greater. 300 is not greater than 1,500. So in the short term, keep it. Why? Well, if you drop, you're going to make a bad problem worse. Sales, 0. Variable cost, 0. Contribution margin, 0. But you still have your unavoidable fixed costs of 1,500 bucks. So now you're going to have a loss of 1,500, which is greater than the loss you had before of only 300. Don't do it. You're going to make a bad problem worse. Now, somebody who's smoking might be thinking, yeah, we're losing money, man. You got to sell that. You ever see Cheech and Chong? Old school, funny as hell, rent it. But not right now because you're studying for the exam. Rent that when you're done and you've passed all 4 parts. All righty, baby. I feel like I just gave birth to a CPA. Oh, my goodness. Now, I'm going to invite Rob, Rebecca, John, Mad, everybody come on back. I know I got other slides to show. I hope sincerely, guys, you got a lot out of this. We're going to be doing this again, but we went from 1 hour to 2 hour, and then we're going to 3. Here's the questions we're going to do next time. Look real quick. Can you see him? Can you see him? Can you see him? Can you see him?
So I'm going to jump in.
Yeah, go, Rob.
So we want to thank everybody. We need to wrap this up. There are a couple of questions that Matt has collected. She wants to have you answer live for everybody.
Sure.
So she'll ask you your questions, and then we'll wrap it up.
You got it.
Thank you, Rob. And thank you all for joining us. Pete, I think you're trying to get to the end there to show when our next BEC Boot Camp is.
My finger. Oh, there it is. No, oh,
don't miss it. Don't miss it.
My finger hurt. Damn.
Our next BEC Boot Camp is on October 21st, and it will be a 3-hour session. And I think, Pete, so you were saying you want to cover some new questions, and we'll probably revisit some of the questions from this webinar.
Man, I got enough new questions because Rob,
new ones
on the money, it's going to be all new stuff. 3 hours, all new.
All right. You heard it here. You heard it here. Thank you all. And then if you want to move to the next slide too, there's a great recap of what's coming October 31st. Our 2024 course is going to be live. If you're a current UWorld student or a Wiley student, which is now part of UWorld, you will have full access to the online 2024 course materials once they are live. So look for that. It will include yours truly here, Peter Olinto, as one of the instructors, Roger Phillip, and all of our incredible instructors as well. So stay tuned. And then also for you current UWorld and Wiley students, it has been so great to see the questions coming in, especially when you are helping answer questions for each other. If any of you are interested, any active students are welcome to join our Facebook study group, which is only open to UWorld and Wiley students, but that's also a great place to learn from, help your peers, cry together, laugh together, all things CPA. So please take us up on that and check that out. All right, we're over, as you know, so let's ask a few questions here. One of the ones that came up last time, Pete, written communication. You know you have great tips. Thank you, CPA man. Love the bandana. Can you give us some tips on written communication?
Yes, so what I said last time holds true today. If English is your first language and you're accustomed to writing essays in English, look at our detailed explanatory answers. It's not like they're asking you, it's not like college where it's graded for the content. They're not going to say to you, hey, list the elements to make a contract enforceable, or list the type of costs that are relevant versus irrelevant. It's not what it's about. Can you express yourself clearly in a written form professionally? So it might be writing a memo to a partner, a manager, a coworker, a client. What's the issue? What's your rule, analysis, conclusion? It can't be totally off base, but it's machine graded, folks. You've got to look at our detailed explanatory answers. It's not regurgitating memorized facts, so relax. It's just being able to express yourself clearly, concisely, correct grammar, punctuation in English. You look at our detailed explanatory answers, you'll see exactly what we're looking for, okay? Now, I caution you, if English is not your first language and you're not accustomed to writing essays in English and it's causing you a lot of stress, if God forbid you don't get BEC in 2023, don't sweat it, because the writing's going away in 2024. You might have a mastery of the concepts, but the writing is stressing you out. It's going away in 2024. So it's all good. Either you get it in 2023 or you don't have to worry about it in 2024.
Thank you. That was great. Okay, next question. Can you give a little bit of information about the CPA evolution and also your thoughts on how some of the sections might be harder or more difficult or easier in your opinion?
Yeah. So the big changes are financial. There's still going to be 3 core sections that correlate very heavily with today's financial, regulation, and audit. However, with that being said, in 2024, because they have those 3 core sections, financial, reg, and audit, they're adding 3 disciplines, which if you get BEC out of the way in 2023, the beauty is you don't need to take a discipline, because if you pass BEC, that equates to any of the disciplines. But what's going to happen is in 2024, the core subjects relative to today's financial or today's reg or today's audit, our belief collectively is that in 2024, those core parts will be relatively easier, because that's supposed to represent kind of the intro or the intermediate level for those various topics, right? And then the discipline would equate to the more advanced level topics, the advanced accounting or that second class in tax or IT, whatever it is. So for example, financial in 2023, there are a lot of topics that in the financial core in 2024 are not there. So the financial core 2024 is relatively easier than the financial part in 2023, because certain advanced topics, pension accounting, certain things in leases, derivatives, transactions, certain things are going to be moved to the bar section. The bar section has a lot of what's in BEC, the cost, the managerial, the corporate finance, but it also has some of the harder topics from FAR. So you can avoid that, the FAR in 2024, easier than FAR in 2023. Same thing, like if you look at the tax, there are certain things currently in reg in 2023 that in 2024, if it's higher level difficulty, won't be in the reg core, but will be in the tax discipline, which has the more advanced topics. And then the tax discipline has, more, rather than just historically taxes focus so much on compliance, cranking out returns. Well, if you got a CPA, a master's in taxation, or a law degree, you might want to do consulting, tax planning. How do I avoid taxes? Never mind paying. Well, how do I avoid it legally, not illegally? Well, that's what a lot of the TCP is going to be. All righty. So at that advanced level, and then the IT stuff, folks, so important today, as you all know, that every part of the exam in 2024 is going to have some IT type component, how it relates to that particular subject matter. And then the IT section, is for the folks who have a degree in accounting, but they're the tech specialists, the IT people, and they put it together and then they have their niche. CPA tax people do the tax, CPA audit, whatever. A lot of the audit people are going to do bar, the tax people, the TCP, the techie people will do the tech section. So yeah, so that's pretty much how it's going to equate. From what I understand, somebody at the AICPA and or NASBA thought, hey, you know, we're losing accounting majors, which is great for you guys. Why? Supply and demand. The demand for CPAs is still high. I don't care about AI. It's going to take a while, long while, after our lifetime. You're not being replaced anytime soon. All righty. So there's a tremendous need for CPAs, and yet the supply is dwindling. So they thought, hey, if we change the format and you get to specialize in a part, rather than everyone taking all same four, hey, if you're going to be a tax person, take the tax, or the audit, take the bar, IT. They thought maybe that'll help grow the accounting majors. We don't think so. So what they're doing is, to help you out, anybody who has credit for a part passed in 2023 or earlier, if that credit has not expired by January 1, 2024, if you still have credit, not on December 29th of 2023, that don't count. January 1, 2024, you have credit for a part that hasn't expired, forget whatever that expiration date was going to be, forget it, because they're going to extend it all the way out to June 30, 2025 to make sure you people aren't screwed with the change in format while you're in the middle of this process. In addition, that's happened in every state, but in addition, there's talk about, at some point, NASBA has recommended, the states haven't voted on it yet, or at least most of them haven't. I don't even know that any have, but NASBA has recommended that said, hey, starting in 2024, at some point, states, if you want to approve this, we think it's a good idea that instead of having 18 months from the time you've passed your first part to pass the other three, let's instead make that 30 months, or no, instead of 18, it'll be, what is it, 28 months, 2.5 years. So 30 months, right? 18 plus 12, yeah, that's 30 on your planet. I'm not sure about mine, but what I was saying is they haven't enacted this yet. But to not screw people who are working crazy hours, have a family, rather than having 18 months to pass the 3 parts you haven't passed yet, at some point the profession, hasn't happened yet, is going to make it a total of 30 months, an extra 12 months, but that hasn't happened yet. Keep checking your state to see if and or when that happens. You need a freaking degree just in all this stuff. Holy God.
So true, Pete. All right, thanks. We have we're already over time, but we're going to do 2 more questions.
We're not over time. Matt, they got nowhere to go. They gave up their gym membership. They did the humane thing. Listen to me. They did the humane thing and they put their dog to sleep because they got no time to walk or feed that dog. They're studying all the time.
Pete, no. Okay. No, don't put your dog to sleep over the CPA exam. Okay. I'm studying for BEC, but struggling with identifying what information from the question is relevant. I know Peter mentioned about going to the stem of the question and set formula, but given the time factor during the exam, would I have enough time to do a setup of the formula and work the problem?
Absolutely. You slow down to speed up. It's counterintuitive. When you're reading facts that you don't know what to do, I ask you to go outside right now. I said, go outside and observe things. And then you come in a minute later, I say, how many people were wearing hats? You're like, well, Pete, I didn't know I was supposed to look for people wearing hats. Know what you need to do with the facts first. Set up the facts, then you can cherry pick the relevant information. You slow down. Listen to me. Trust me, I'm a professional test taker. I'm not in the, as my brother, I say, you're not in real, all you do is teach. That's right. I've had CPA, CFA, different levels, bar exam. I can't do any of this stuff in the real world anymore, but I can take the damn test and do really well at it. Slow down to speed up. Read the question stem, set up your formula, then you cherry pick the relevant information. If you have the formula first, you know what's relevant versus what's irrelevant. Do you have the time? That will save you time in the long run. Damn it.
Fantastic advice. Thank you. Okay, last question for today.
Let's go.
What is a recommended amount of time to study for the BEC exam, especially if you're working full time? What do you recommend?
That's got no bearing. Whether you work, listen to me, that is a common misnomer. No. It doesn't change the number of hours. The number of hours is what the number of hours is. When you're working full time, that changes whether you're going to spread it over a month, 2 months, 3 months, or 4 months. The average number of hours is 80 to 100. Average. Some people do more, some people less. Tell me how you did in cost accounting, managerial accounting. Did you have a class in corporate finance? How'd you do? How'd you do in economics? And how'd you do it in IT? That's going to tell you. So don't tell me you're working full time, then you better start earlier because you need to spread it over a longer period of time. But it's historically 80 to 100 hours. It all depends upon how many hours you have per day, per week. That'll dictate how early you need to start. But the working full time doesn't give you look, shortcuts, somebody said we're more efficient. BS, man. Shortcuts will get you a 70 freaking 4. Don't waste your time. Do it once, do it right, start early or increase the number of hours per day. You could do it. Get up an hour or two earlier every day to put those hours in during the week, and then you'll never have to do it again. And it will pay you back the rest of your life. Those 3 letters will continue to generate revenue for you. Even if you leave the accounting profession, it's that well respected. And Matt, before we go, I got to add, listen, I know a lot of my students who are studying, I can't remember what the hell the name of that other course was, but you know who I am. And look, it's only fair you've been studying with me, or if you're with Roger and you know Roger, your firm needs to do what's fair and right by you. Choice is good. Competition is good. We work harder. We want your business. That's why we're doing this. We want to give you the best product at the best price and get those passing rates. 94%, we are kicking ass, baby, and it's only going to get better. Your firm needs to give you that opportunity. They need to give you the choice. Save your monogamy for your spouse, not your CPA review course. Cherry pick. Who do you like best for this part of this part of this part? If they're telling you can only take this course, let me tell you something. That's not good for you. That's not good for your firm. And that's good for that damn course. I can't remember the name of it. Let's go.
Thank you. Let's go. All right, everyone. Thank you so much for joining us. We will have the recording for this sent to anyone who registered by the end of day Monday. It will be sent via email, but it will also be populated at the bottom of the link for the free BEC. Yep, that free BEC Boot Camp link. It will be there as well. Anyone can access it at that time. All right, thank you so much.
October 21. Let's go. October 21. I'll see you there.
Thank you, Pete. Thank you, everybody, for attending. Good luck.
You guys are awesome. Thank you all. We appreciate your time. Good luck studying. We'll see you on the 21st. Good luck.
Thank you.
Bye, guys.